My name is Bilal Ayyub. I'm engineering professor at the University of Maryland and direct the Center for Technology and Systems Management. Also, I had the pleasure to be part of the Applied Economics Office for many years. I collaborated with them for maybe decades now at NIST, and recently I'm visiting professor at the Imperial College and a co-director center at Tongji University. I mean, all of these collaborations, I found them over the decades to be quite enriching intellectually. The setup at Tongji University is the largest civil engineering department in the world. And Imperial College is the same thing. It's the strongest department in the UK. This work is collaboration. It was done for after the wildfires in California, primarily 2018, and the litigation and the financial implications to the companies and so on. And it was needed for the California Commission, Utilities Commission, and the focus was on the economics aspects of it. I was asked by KPMG to join the team, and we needed to put the case to the California Utilities Commission to allow spending more, basically to protect against wildfires, and this requires approval in order to increase rates. And we did put the case successfully. Then I thought to engage as well two economists from NIST that they joined later on. And the entity that presented the case was PG&E, which is one of the California utilities. And you could see from the authors listed the collaboration that happened. And I believe it was well received. Most of the materials that I'm covering in here, not all of it, is covered in the open access paper that's cited at the bottom. And you could find it easily, just my last name, Wildfire Risk Aversion. Um, uh, the outline of my talk today, I'm going to start with some terminology, just focusing on a couple of terms. And then I would like to present the complexities associated with wildfire when it comes to the financial aspects of things. And then examine what's called the loss accumulation models, which are the foundation for doing the economics related to hazards. Then show limitations of utility theory. And that was one of the reasons I was brought in, because the California Commission was not happy with the use of utility theory, and they wanted something which is on a more solid foundation. And what we come up with is a market-based loss amplification factors that will account for risk aversion as opposed to judgment based on utility theory. And I'm very familiar with utility theory, so I just want to make sure to put this point up front, because it's not that option is known to the team and to the people, and the intent was to move away from it. And then I'm going to show how this fits into the economics of hazard resilience and finish up. Now, in terms of terminology, all of you have background in risk, but I'd like to highlight how the term risk differs depending on the field. So in engineering, the common used definition, which is shown at the top, and the key phrase in there is potential loss. So risk in engineering is defined as a potential loss from exposure to an event. And it has, failure, the probability and the consequence, and population, property, environment at risk, and so on. But the key item is potential losses, focusing on the losses. Sometimes we do benefit assessment, but it's rarely the case. I mean, in planning, we do look at benefits, and sometimes it's needed. But always, if I do risk management, I'm looking at savings in terms of loss reduction. But I just want to bring that to compare it with other definitions. From finance and banking, especially, I think after the crisis that happened in 2008, the ISO standard was produced, and I do like the definition that came out that was put forward as highlighted in red. Is the effect of uncertainty on objectives. So you set your objectives, and if there is an event, or and of course there are uncertainties with the event, it could move the objective. You could move above the target or below the target. So it does allow for the swing both directions. So, I mean, it is compatible with the engineering definition where the target could be some acceptable level of it could be risk or safety considerations, whatever it is, and that will become the objective. And so they are compatible. The third definition is from economics, which is defined, risk is defined as a situation, including an economic activity that has uncertain outcomes with known probabilities. If you put in the probabilities being uncertain, then you'll increase the complexity. But the whole thing is the reason we have risk is because of the uncertainty. And I now, if you look at the figures that I have on the right in here, risk neutral, meaning that when you look at the failure probability and the consequence as an ordered pair, you could move up on straight lines that you don't really make a distinction between high loss and low loss. It's by as long as, let's say, the expected value, which is the product of the two, is the same. But we know in real life that there is the decision maker will vary depending on how much their tolerance to loss. So those curves could, become nonlinear, and this represents risk aversion, which I'll define later on. It's very common in many fields that people look at whether it's monetary loss or fatality in the form of one minus the cumulative distribution function. We call it loss exceedance, or it could be annual rate exceedance value. And these curves, they are actually the density curve of, in this case, we are showing loss on below zero and gain above zero. So there is a distribution. Think of it as return from a project. And if I take this curve and calculate the cumulative distribution, and then one minus the cumulative distribution becomes an exceedance loss curve, which is typically what's shown in here. But this one is something that we could relate to, that if I have a project, it could be when we bid on a project or undertake a project, certainly I'd like to make sure that the average return is in the profitable is in the green, but there is the tail which could lead to losses. So all of this puts the foundation for doing the economics related to hazards. Now, in terms of the terminology, I know the slide has too many terms in it, but I just want to show you the flow that starts with an entity which is undertaking the risk, having the appetite for that risk, and it is within their risk tolerance, and it's try to understand their risk preference, which is the basis for defining as a definition of risk attitude. And risk preference has two dimensions. One has to do with the variance in the return, and the other one is the psychology aspect related to having a loss. So these two, they come together, which will impact how we do the analytics related to the risk attitude. The risk attitude, typically we do risk neutral, but if I want to be risk averse, this means I have to spend more to manage the risk. And there is the third attitude, which is risk seeking. And risk seeking comes out of, as a result of being very comfortable with that risky event and the belief and the ability, having the competency to actually deal with that risk and manage it to counter the potential occurrence of an event or mitigate the consequences and so on. So a risk-seeking attitude comes out of the comfort of being able to deal with that event. All of this is done while staying within some acceptable targets, and always there is some residual risk regardless of the action we take. And sometimes the way we stay within the acceptable level is by passing some of that risk through insurance or other legal instruments to other parties. And of course, there might be a regulatory requirement related to human effects on humans, whether it's health or safety concerns. And all of this could feed into the resilience dealing with recovery and so on. So these terms are related, but I'd like to move to the next item, which is the complexity of what we are dealing with from the financial aspect of things. This slide, which I put together when we're trying to understand in my mind all the entities and how to deal with it. So I drafted this slide, and basically it has to do with wildfire risks. And what you have in here, the top row, the blue boxes, they are all losses, loss categories, death and injuries, health effects, property damage, suppression costs, and other economic environmental costs. And then the next item is you could translate that into basically property damage, life and injury. So you could put them into grouping. This is more of the economic valuation, monetizing them. And then the bearer of the cost, which is the next group, vary, and they are listed in here. It could be the person affected directly, the property owner, and we could have the fire department, federal firefighting, harmed parties, and there will be transfers through existing legal documents and so on to insurance or to the utility companies. Like some of the firefighting activities will pass if the source is from electric power transmission lines and so on. They could pass to public utilities. And those, as well as insurance companies' claims that they will get from owners and so on, through subrogation, it can go to the public utilities. So there is all of these transfers. And the second item, then the public utilities will transfer it further to basically through rate. Either they will transfer some of it through liability insurance that they have, and they will transfer it through rate increase, but this is regulated, so they have to go through the regulating commission, which could be challenged in court, those rate increases. And that's what happened in 2000, after the fire in 2018. It was challenged because there is a law it's called the inverse condemnation law that will allow passing wildfire loss to rate increase, and the court ruled that they cannot pass that significant loss, and hence basically additional examination was done. Now, for the utilities, there are other considerations. One is reliability of the system, because interruption comes with cost, and they could be affected party as well as revenue decreases. It affects these utilities are owned by companies that are publicly traded, so there is a financial aspect, capital investment, and so on. And all of this will fall into feeds into this process in a bigger picture. Now, to deal with all of this, there are legal considerations, limitation of liability, and so on. We'd like to have utilities to be functioning in a healthy way. There are liability through insurance, whether it's regular insurance or cat bonds and so on. And and it's possible to create standardization, which doesn't really fully exist at the present. There is interest in that area to make it consistent, at least across different utilities and different hazards. So this gives you an idea about the complexity of what we are dealing with. Now, in terms of the economic model, the primary building block for it is really loss accumulation model. Because if I have a planning horizon for a year, typically in insurance, it's a planning horizon of a year, because you could adjust rates every year and so on. So you're looking at how many claims I'll get in a year and so on. And this could be related to any event of interest. So I'm showing in here several models. This is the insurance model based on work I've done many years ago for Hartford and others, and I covered that in my risk analysis in engineering and economics textbook. And basically, you could see there is a Poisson distribution, and there is the intensity, and summed up probabilistically over some planning horizon T for an event that has a rate of occurrence lambda. And what you'll get is a CDF, cumulative distribution value of the loss. Now, in Manual of Practice 140, you could see the same thing, that there is loss, it's accumulation through some conditional probability, and there is a discount rate. The planning horizon is longer in here. In here, we don't really need to include discount rate, but in here we do. The NIST publications, I collaborated with Stanley Gilbert. This is part of the community resilience and so on, and there is the other document, a special publication of NIST 1197. And if you look at 1197, you could see there is the loss accumulation models with discount rate. So all of them are. So the primary item is the loss accumulation model, key assumptions, typically boson process, which means that they are independent losses. Whenever there's a claim, it's independent and it's random, and it's stationary to some extent because lambda is not time dependent. Lambda is number of claims per unit time. So that first assumption is independence. The second assumption is risk neutral, because we are taking the losses the way they are with the economic valuation. So we're not attaching to it the attitude of the bearer of that loss. Now, multi-attribute utility theory is basically a weighted scheme using scoring. So you have a domain which is the loss domain. So you transfer it, you map it to another domain, you call it utility, and that mapping is subjective. But the utility does not have a unit. So you are taking it. So you are trying to deal with the complexity by taking it to another space that really lacks unit, and then you'll add them up with weight factors. So at the very end, you'll end up having just ad hoc addition of utilities that does not really, it's hard to keep it rational if the complexity goes up. I know it's very well established, but really you could find many holes in it. And the challenge was with wildfire that the choice of the utility function, the choice of the weight factors. I'm showing here some charts and so on. They're all coming from publications used by utilities submitted to the California Utility Commission and so on. So we were moving away from it. Now, just to show you the point of the independence, right? So if we look at the the recent wildfire in Southern California and LA, the conditions were drought conditions, low humidity, buildup of vegetation from the winters, and we have the wind, the Santa Ana wind reaching 100 miles an hour. The impacts, that's when I was preparing for the presentation, it was some time ago. These are the numbers that were reported at the time: 29 people dead, 200 evacuated, 18,000 properties, 57,000 acres, so $164 billion in losses, insurance related. Some attribution was done trying to see what's the impact on GDP, and then the impact on local businesses and so on. So these numbers are time stamped by January 31. Now we did a paper recently, just came out in 24, and that is for working for the foundation in Italy for the Italian government, and we have a small grant coming from the Italian government that will be starting this summer. And the focus was in Sicily. Italy, I consider it's like the California of the US when it comes to wildfires. So they do get a good share of them, especially in Sicily. And we came up with the systems thinking that you need to start from prevention, preparation, detection, response and management, recovery and adaptation. Adaptation is key in terms of choosing vegetation, changes in design, and so on. So it's a cycle. This paper also is open access, and that's the link for it. I'm not planning to cover this, just want you to be aware of the systems thinking. I'm looking at a very narrow slice in here. It's more in the preparation, the economics aspects of it. These are some of the images and the location of the fire, but I want to emphasize first, before I get into the risk aversion, I want to look at the independence, the assumption of independent losses, which is the foundation for the accumulation loss accumulation models. We use a Poisson process, and all of you are familiar with the Poisson model. I mean, this is the Poisson distribution for different lambdas, and it gives you an idea about the shape and what's the probability of having, five events, 10 events, 15, depending on how many events per unit time that you get, just to give you an idea about the shape of the distribution. Now, the thing is, if I consider the losses, every house or property burnt in an event, such as the 25 Southern California fire, the lambda is not really constant. So you could say, well, the way the losses are being accumulated for a particular event, which will impact, it could be the insurance industry or the local jurisdiction, is not staying the lambda is changing with time, and it changes depending on the characteristics of the fire. So how can we account for that? So this is a summary of the Poisson model, which is a practice that's we used. So if you have a planning horizon and you are looking at how many claims or how many events I'll have, and each event has a different intensity, which also I could characterize. So it's two parameters. One in the model, one is the number of events per unit time, and the second one is the distribution of the intensity. The two put together, it will give us the total accumulation of losses. Now, I'm going to start by focusing on lambda. So I think lambda is time dependent. And to make it time variant event rate, I could start with a base rate, and then I could uh, add to it through some parameters. And those parameters, typically people use two parameters, alpha and beta. The alpha is what they call a self-excitation factor, that the base rate will end up giving you more events, which is the way wildfire works. That have a fire in a house, and then it will ignite other adjacent properties and so on. And this could be characterized through the alpha, which is tied to correlation, and there could be the wind and other consideration. I mean, this has to be require that we need to estimate it, right? And the second one, the beta, which is the decay rate. Once you have an event started in this manner, what is the decay rate in it? There is the combination of alpha and beta sometimes is called the kernel for the model, and one kernel which is sometimes used is called the power law decay kernel. I tried to do some fitting based on the California. There wasn't enough time. It just is, I thought I could do it quickly, there were many assumptions that has to be made and data collected. I stopped there, but I think this model might offer the way forward. And the implication, R is the correlation, the level of correlation, which is internal to the wildfire, the way it's spreading through this self-excitation. And if R, and it has implications. I mean, if you look at the implications in here, one for emergency planners, if we can characterize the R from the event, I'll be able to do the proper planning to reduce that self-excitation. In terms of insurers and financial institution, the meaning of having an R or an alpha, that the loss accumulation will become larger than what you will get from the assumption of independence, which is intuitive. I mean, we should have that. It should also affect the way we do urban planning and planning communities, because if it could require, whether it's the roofs and the siding and all the details that we heard in the previous presentation, as well as the vegetation type and so on. So all of this could be impacted by characterizing those parameters. That's all I have about um, basically the assumption that lambda is time variant, the event rate, and the assumption of lack of that we have correlation, basically. So I'm going to shift to the risk aversion. Right? So I'm shifting to the next slide. Those figures I covered earlier. So if I look at only the tail where I have the losses. So this is actually these histograms I use when we're doing energy work, oil and gas, and these are facilities to be built where the company that's doing them as basically EPC contract. They were sizable contracts, and these are just made up numbers. So it's a profitable project, but there's the potential that things could go wrong, and the project will be in loss. So the tail, which is anything below the zero in here, that is the item of concern. And basically what was done in there is by taking this tail and breaking it into slices, basically layers of losses. The first layer could be self-insured pretty much, and the next layer could become basically part of it in some structured contract passed to to an insurance company, and the third layer will revert back to the original owner of the risk. Right? And that approach was used in large projects, including, by the way, the channel between the UK and France. It was built in that way, and it was requirement by the UK government to issue a bond for building the channel. That they wanted to make sure that there is a ceiling for how much money the government will provide, and they required having some creative insurance model. There is a Harvard Business School about that case. And now going back, so my focus is on the tail in here, and now what I have in here is wildfire losses represented by what we see in here. Um, so now what I could do is and what I'm trying to do is model risk aversion, right? Now, risk aversion, which we defined earlier, is an attitude, it's a risk attitude. And there is the variance there are two considerations. One is variance in return, the uncertainty, and the second one is the psychology aspect of it. How am I willing to tolerate that? And the way people react when it comes to an exposure of this type is they will buy insurance. Or if the exposure is too large, not for an individual, but for a company, they might issue a cat bond. And there is a sizable cat bond to deal with seismic as well as wildfire. There is a cat bond for wildfire. So what we did basically is we looked at first the insurance. We looked at both, and the third market, which I don't cover in here, but I have a lot of materials on it, is regulations. So when you issue a regulation, there is cost to implement that regulation, which will end up saving some losses. So actually, you could look at the cost of the regulation. It's like an insurance, the cost of the regulation versus the saving in losses, and from it, you could learn what is the attitude of society through members of Congress or policymakers to basically commit public resources for a regulation because it saves life or it enhances health and so on. So you could infer from that what is the risk averse minds, to what extent there is risk aversion. So there are three of them, but I'm going to cover only two, insurance and cat bond. So basically for the insurance, we looked at how much the premiums collected, how much the insurance company will collect in premiums versus how much claims they fulfill, which is their loss. And we put together what's called premium to loss ratio. And that ratio becomes it will be larger than one because it's insurance companies, they have to be making some profit from this. So when you have the premium total income divided by total claims, it's a number which is larger than one on the average. Sometimes you might have things that are losing, but then the next year they'll increase the rates and they'll recover the loss and so on. So so they use Bayesian methods and it's adaptive in nature. So if we think about it that way, it's the premium divided by the loss ratio. I'll end up having a factor which reflects but it's determined by markets because insurance companies, they have to sell it to the insured, and the insured, they have to be willing to write the check for the premium. So through that market dynamics, so basically the society will determine what is this ratio, and this ratio is larger than one. And what we could do is take that ratio and use it as what we put in the paper as a loss amplification factor. So it's a factor that will amplify losses. Then it will reflect the risk averse mindset of the community or the society when it comes to that event. And once I have those multipliers, then they could be different by different type of loss and so on. Then I could use those in my economic models. And the same thing for cat bonds. The ratios will become larger a little bit because the uncertainty is bigger, and that's documented in the market. So it's all market based. There is no weight factors, utilities, and so on. And if there are situations where we don't have the market is not yet established, we could use expert opinion elicitation, focus groups, and so on. And we've done things of this type. I mean, I did actually in economics. We've done several studies for the Army Corps of Engineers and the U.S. Navy and the Coast Guard, looking at economics related to safety using expert opinion elicitation. And there are ways to supplement all of this through questionnaires and surveys inspired by this thinking to fill the gaps if there are any. So I just want to take the case of the insurance. I want to make sure that you understand how these factors, which I'm going to use later on, how they will come in place and the rational, are they rational? So if you look at insurance, I mean, there are two players. There is the buyer, the insured, let's call it player one, and there is the insurance company, let's call it player two. And there's a transaction, and everybody is above 18, as we say, and at will they want to do that transaction. The originator of the risk is the player one, and they will transfer it to player two. The reason player one wants to transfer it and not be self-insured, although financially, on the long term, they will be ahead if they do it that way, is because of the psychological aspect. They don't want to be stuck with a big loss. And they can't, they cannot, they might not survive an event of this type financially. In here, why would player two will take that risk? Because they will pull it. They will get that risk from everybody and they will build up their own model and they will make sure at the very end that ratio, which I talked about earlier, is profitable. So there is, and they will add their profit and the cost of doing business and all of that. And the insurance market is regulated. They are required by Department of Treasury. They have to file reports about premiums and claims and so on, and they are all available in the public domain. So basically, there is loss aversion in here, loss aversion. They don't want to see the loss. Those guys, they have risk aversion that the loss, but also they are counting for the probabilities and they are building an economic model. So there is loss aversion versus risk aversion. Their cost in here is the premium, the insurance. It's a sure loss. When you write the check, the insurance company is a sure loss. And here the cost is the cost of the operation, as well as, of course, fulfilling the claims, which is part of the model. Sorry about that. The return, peace of mind.
Bilal,
Yes,
how many more slides do you have, buddy?
I have. How many minutes remaining?
Well, you've been at it 30 minutes now, so you're
Oh,
30
okay.
minutes
All
in.
right. So with that, so yeah, you see the picture.
Hmm.
Let me, I'm going to jump further. I have too many materials in here, but what I'd like to do is go to the model, right? So basically, and this will be pretty much the slide before the last to conclude. So the way it works. So once we get those loss amplification factors driven by markets, I'll take an economic model, which is the loss accumulation model that I described there earlier. Here are the intensities, right? And these could be different sources, and I'll amplify them to reflect from through using those ratios. I'll end up with amplified losses. Once I have the amplified losses, then I'll use the regular, basically, model, the loss accumulation model with the Poisson distribution and so on. So I just the beauty of this model that it doesn't really change the framework itself. Once you amplify the losses to reflect the risk aversion, then the rest will follow in the same manner. And these are just the math and the examples. We covered two examples. One is from the NIST Wildland Urban Interface study. There is a report, and this is based on the work that was done for PG&E as an example. So I conclude in here that losses and benefits, and this is, by the way, could be applied to benefits as well. So losses and benefits can be amplified to reflect risk aversion, and those amplification factors can be basically estimated based on applicable markets. And then we could use existing tools for doing benefit cost analysis once I have the losses amplified. And the work that we had was recently, I was very pleased, surprised to know that was cited by a Harvard study on macroeconomics and climate change, which is just it's being released soon. Thank you. Sorry for taking longer than planned.
That's okay. You're obviously very passionate about this, and so I totally understand. Questions for Bilal? Well, I'm going to break the ice.
I'm
So,
sorry, can
oh,
I
go
just,
ahead, Yvette.
is there some place that we can read it now, or you're saying it's coming out soon, Bilal?
No, that document was submitted to the academies, and it was reviewed, but it's not released yet. Are you referring to the 25 document or the paper that I presented, which I had the link in the very first slide, is in the is available. I could put that in the chat session too.
Yeah, could you put in the chat system so we can read it again?
Yeah, sure.
Thank you.
Happy to do that too.